Yeah, listen. Uh, we
The
fucked
gold
up.
standard is a monetary system in which the value of a country's currency is tied to the value of a specific amount of gold. Under this system, central banks are required to hold a certain amount of gold in reserve, and they can issue new currency only if they have the corresponding amount of gold to back it up. Dropping the gold standard was a major economic decision that was made by many countries in the 20th century. There are several arguments for and against this decision, and it's still a topic of debate among economists and policymakers today. One argument in favor of dropping the gold standard is that it gives governments more flexibility to manage their economies. Under the gold standard, central banks are limited in their ability to issue new currency because they have to hold a certain amount of gold in reserve. This can make it difficult for governments to respond to economic crises or to implement monetary policy measures to stimulate growth. By dropping the gold standard, governments can issue more currency as needed, which can help to stabilize the economy during times of crisis. However, there are also several arguments against dropping the gold standard. One concern is that it can lead to inflation, as governments may be more likely to issue more currency without the constraint of having to hold a certain amount of gold in reserve. This can lead to a decrease in the value of the currency, which can be harmful to savers and investors. Additionally, some argue that the gold standard helps to keep governments accountable, as they are required to maintain a certain level of gold reserves in order to issue new currency. Without this requirement, governments may be more likely to engage in irresponsible fiscal policies. Overall, the decision to drop the gold standard was a complex one, and it's difficult to say definitively whether it was a mistake or not. Some economists believe that it was necessary in order to allow governments to better manage their economies, while others argue that it has led to inflation and other economic problems. Ultimately, the impact of this decision will depend on the specific circumstances and policies of each individual country. In the early 20th century, the United States was facing economic challenges that led to the eventual abandonment of the gold standard. The gold standard is a monetary system, in which a country's currency is pegged to the value of gold, with the government promising to exchange paper money for a certain amount of gold. This system had been in place in the United States since the late 19th century, but by the 1930s, it was no longer able to support the country's growing economy. One of the main reasons for the decline of the gold standard in America was the First World War. The war had a significant impact on the global economy, as many countries borrowed heavily to finance their military efforts. The United States, in particular, was a major lender during the war, providing billions of dollars in loans to its allies. This led to an increase in the supply of money and credit, which in turn led to inflation. The United States also experienced a period of economic expansion after the war, which was fueled by a surge in industrial production and a growing consumer market. However, this expansion was not sustainable, and by the late 1920s, the economy was beginning to slow down. The stock market crash of 1929 and the subsequent Great Depression only exacerbated the situation, leading to a significant decline in economic activity and a decrease in demand for goods and services. The gold standard, which was designed to stabilize the value of money and prevent inflation, was unable to keep up with these changes in the economy. The government's gold reserves were insufficient to meet the demands for gold that were being made by the public, and the Federal Reserve was forced to raise interest rates to try and curb inflation. This led to a further contraction in the money supply and a worsening of the economic downturn. By the early 1930s, the gold standard had become untenable, and the United States began to take steps to abandon it. In 1933, President Franklin D. Roosevelt implemented a series of measures known as the New Deal, which included suspending the gold standard. This allowed the government to print more money and increase the money supply, which helped to stimulate economic activity and reduce unemployment. The United States officially abandoned the gold standard in 1971, when President Richard Nixon suspended the convertibility of the dollar into gold. This decision, known as the Nixon shock, was made in response to a persistent balance of payments deficit and a growing trade deficit. By ending the gold standard, the United States was able to manipulate the value of the dollar and control the money supply more effectively, which helped to stabilize the economy. In conclusion, the United States abandoned the gold standard due to a combination of economic challenges, including the impact of the First World War, the economic expansion of the 1920s, the stock market crash of 1929, and the Great Depression. The gold standard was no longer able to support the country's growing economy, and the government was forced to take steps to abandon it in order to stimulate economic growth and reduce unemployment. The decision to abandon the gold standard was a significant turning point in the history of the United States, and it has had a lasting impact on the country's monetary policy. The dollar, the official currency of the United States, has long been considered a symbol of strength and stability. It is the most widely used currency in international trade, and it is accepted as a reserve currency by central banks around the world. But is the dollar really worth anything? One way to measure the worth of a currency is to look at its purchasing power, or how much it can buy in terms of goods and services. Over time, the value of a currency will fluctuate due to a variety of factors, including inflation, economic growth, and political stability. In the past, the value of the dollar was tied to gold, with the US government agreeing to redeem paper dollars for a specific amount of gold. This system, known as the gold standard, helped to stabilize the value of the dollar and promote international trade. However, the gold standard was abandoned in 1971, and the dollar is now considered a fiat currency, meaning it is backed by the full faith and credit of the US government rather than a physical commodity. This shift has allowed the US Federal Reserve, the central bank of the United States, to have greater control over the money supply and interest rates. However, it also means that the value of the dollar is subject to the actions and policies of the Federal Reserve and the government. One factor that can impact the value of the dollar is the level of inflation. When prices for goods and services rise, the purchasing power of the dollar decreases. The Federal Reserve aims to maintain a low, stable level of inflation, but if inflation gets out of control, it can lead to a devaluation of the dollar. The level of economic growth can also impact the value of the dollar. When the economy is doing well, the demand for goods and services increases, leading to higher prices and a stronger dollar. Conversely, when the economy is struggling, the demand for goods and services decreases, leading to lower prices and a weaker dollar. Political stability is also a factor that can influence the value of the dollar. Countries with stable governments and economies are generally seen as safer places to invest, which can lead to a stronger currency. On the other hand, countries with political instability or economic turmoil may see their currency weaken as investors lose confidence in the stability of the country.